Good morning, members. So this is the next video in the series of international valuation standards that we are going to study. And as from the backdrop, you can see that today we are going to discuss the glossary items or the definition kind of item before the specific asset and general standards, right? So everything will be in a systematic manner and proper detail. Before I start, I must clarify one fact to you that this particular video is for the members who are going to do the who are going to appear for the exam. For the members who are going to use these videos of valuation standards for practical purpose, for these terms itself, there will be a separate video. So now, without wasting any time, and that video will be a detailed one. So now, without wasting any time, let's start the discussion for the day. So first of all, there is a major drastic change as I have opened the red line edition. And if you are not aware what is red line, what is general one, and what are the handwritten notes, then please go through the previous video. That is the first video in this series of the brief, right? Now, after this, first item that has been changed over here is they have clearly mentioned to you that glossary forms an integral part of the standards now, right? Earlier they were kind of definitions and they were not mandatory kind of in mandatory kind of situation, but now they have clarified in IVS 2025 that glossary is also an integral part of your definition. So you cannot miss that also at the time of studies, right? So earlier this was the definition. Now they have clearly mentioned that everything that is being mentioned in the glossary items have to be followed strictly, right? So now we are going to use the handwritten notes for detailed understanding of each and every term, and wherever there will be a change that will be required, we are going to use that proper notes for that, right? So here it is also written glossary items form an integral part of standards and define certain items used in IVS. So what are these items? These are the terms from paragraph number 10.01 to 10.09. So quickly, first is asset or assets, right? So clearly mentioned the right of an economic benefit. Very short, crisp definition is given that if any item is creating any right of and future economic benefits on you, there's no mention of whether you are owner or not, right? It is clearly written that if it is a right that is creating for future benefits or economic benefits can be counted, then that is called an asset. Second, automated valuation model. Now, in the earlier standards, right, this definition was not there. So this is newly introduced. A type of model that provides an automated calculation for a specified asset. You can read at a specified date. Basically, the computer softwares. This is the era of AI, right? So you can use the AI softwares or other softwares which are using the past data to finally find out that what is the value of these kind of assets. There are many softwares like Magic Bricks are using the softwares for calculation of the flat prices nearby the cities and all. So these type of automated softwares which are used is called AVM, automated valuation model, using an algorithm or calculation techniques without applying the professional judgment over the model, including assessing and selecting inputs or reviewing the outputs. Everything automated basis per a particular model will do, that is called the automated valuation model. Third, and this is the exact definition, let me tell you very clearly. Basis of value. Most important, there is a specific standard that we are going to discuss in detail, that is IVS 102, right? And appendix of 10 or 10 section is, and other appendix are there. Detailed understanding will be there in these upcoming videos. So be with me. Here, the basis of value means the fundamental premises, what you are going to assume, what kind of situation you are going to follow while valuing. Is there a kind of liquidation kind of situation? Is there kind of stress kind of situation? Is there kind of independent kind of situation? Is this an orderly transaction? Is it an highest and best use? Those all discussions will be discussed in IVS 102. Reported values or will be based, examples are included in IVS 102. Fourth, paragraph 4, 10.04, clients. The person who engages, again the definition of client is also amended. So here, the person who engages a value for a given valuation, client may be internal, that is valuation performed for an employer. If employer has hired you, Then the client can be internal also as well as the external. When the value is engaged in for a third party like IBC assignments, like other general assignments, or in case of preferential allotments, etc., that is called the person client. Because in the many valuation standards coming down the line, there will be a definition or there will be a use of these words, right? So next, cost or costs, right? So consideration or expenditure required to acquire or create an asset. In the earlier standards, this term was not there. Here they have defined the term cost as the value, replaceable value, a replacement cost kind of thing. It is related to that. So if you want to create or replace or acquire a particular asset, how much cost, how much amount is to be paid or consideration payable. Next, sixth, data. Again, this definition earlier was not there, now it is here. Quantitative and qualitative information available to the valuer is called data for the purpose of valuation. It can be quantitative, it can be qualitative also. Discount rate, we all know, the rate of return used to convert a monetary sum payable in future or receivable in future into the present value, and there will be a detailed discussion on this. Detailed discussion will be there in different standards for intangible valuations. Different discount rate you have to use, where post tax is going to be used, pre tax is going to be used. All the information and instructions will be here in the coming days, right? ESG, very new, very important point these days. You know, there is a separate professionals are there called social auditors. The world is going behind or going for the sustainability goals and all. Even India is trying to follow these sustainability goals and all. So for that purpose, they have clearly mentioned that you have to consider the environmental, social and governance. ESG considerations must also be given. The criteria that together establishes a framework for assessing the impact of the sustainability and ethical practices, financial performance or operations of a company, asset or liability. ESG comprises three pillars: environment, social, and governance, all of which may be collectively impact performance, the wider markets, and society. So, while valuing, you also have to consider the impacts of environmental, social, and governance goals also, and impacts of those valuations on these things, right? Then the ninth uh, part of this is equitable value. This is an estimated price for the transfer of an asset or liability between identifiable, knowledgeable, and willing parties. Now, these type of questions are asked in exams, right? Now, this definition, equitable value, two definitions have been removed. Two definitions have been removed. What are the two definitions? Fair market value, and the second definition that has been removed is fair value. Earlier in the early standard it was there, now that has been removed and a term called equitable value has been inserted. This is an estimated price for a transfer of an asset and liability being under knowledgeable and willing parties that reflects the respective interest of those parties, right? So here in the earlier standard, in the fair market value, it was written that at price would change. Basically, in the United States tax purpose, earlier the definition was specifically related to the US, right? So there it was written that if the buyer and seller, right, if it is giving some additional benefit to one person, like if I am going to purchase an asset which is giving some additional benefit to my company, whereas it will not give that same benefit to some other company. For example, if I am in the sugar industry, right, and I'm going to acquire a company which is going to add in my supply chain, and that can have some additional patent or right or design, and I can take the benefit of that, others cannot. Then the fair market value and the fair value of that asset can be different, right? So in this kind of definition, now it has been removed. It is clearly written that if it is between two persons, knowledgeable, willing persons, identifiable, then it is called the equitable value. Even the fair value definition has also been removed, right? So next definition into the line is input. Very, very important, very small definition, very important, going to be there down the data, assumptions and adjustments. Inputs are the basically when you have to cook food, then what are the things that you have to take? All the salt, chili, pepper, everything that is there. With those things only you can make the food. So here also, if you want to make the food of valuation assign or do the valuation assignment, then the inputs are the main ingredients that you have to be there, and you should be sure enough that what to be taken and what to be left, right? You cannot use all the inputs at same place, and you cannot ignore any essential input also while valuing. So in the coming days, while you study the specific valuation standards, the inputs are going to be discussed in very much detail. So here the data, the assumptions that you have to take as a valuer, and the adjustment to that assumptions, whether it is a equity oriented company, whether it is a debt oriented company, what should be the inputs in that case. So all these are going to be discussed in detail. Determined to be relevant and assessed or selected by the value to be used in valuation based on professional judgment. Next, intangible asset, an identifiable non-monetary asset with no physical substance, right? So it is a definition non-monetary. What is monetary? For understanding a monetary item, you should be clear that what is monetary item then. Monetary items are the one against which the recovery of cash flow is fixed. For example, debtors. So there can be bad debts, but still, if you are writing an amount against a debt of 1,000 rupees, right? So generally, you are sure that this particular asset that I have recorded at 1,000 rupees is going to give me a fixed amount, 1,000 rupees only. It is not going to give me any additional amount or not going to give me any lesser amount. Whereas if you have a machine which is going to be used as an asset for the business, then you cannot be sure that exact how much cash flows against this I can generate. So that machine is basically a non-monetary asset. Similarly, the intangible assets are non-monetary in nature, but an additional thing that will be there is they are not having their own physical substance. Detailed valuation methodology will be understood under IVS 210, right? Asset specific standard. Intended use 10.12, paragraph 10.12, right? So intended use is nothing but whenever you are going to value an asset, so what is exactly the use of that valuation report? That must be clear. Is it for issuing the shares? Is it for insolvency purpose? Is it for like raising the capital, right? It is for uh, buybacks maybe, right? So what is the intended use of that valuation? The reasons for which a value is developed as described in the scope of work, this is also known as intended purpose. And when we study the valuation standards, it is must to understand before start of your valuation that what is the intended use in this case, right? Moving down the line, 10.13, intended user. Who is the intended user? Is it the company? Is it the public at large? Is it a specific government organization, right? Is it taxation authorities? Who is the intended user of that, right? Any part is identified by the client and valuer in scope of work as users of the valuation. Next, invest. No, these definitions are very important for an exam purpose because these are amended now. These are amendments, right? These definitions are amended, and for practical purpose videos, I'll discuss with examples and in much depth. But for exam purpose, you have to remember the definition because they are going to ask you some maybe fill in the blanks kind of questions from here. So, value of an asset to the owner or prospective owner given individual investment or operational objectives. This may be known as worth also. In earlier standards, the worth was given a separate line item as separate definition. The investment value was separate item. Now, they have merged them together. It is also called worth as per the new standards, and investment value is the amount the owner of the asset or the prospective owner should be having the of the investment. Like if I'm purchasing an asset, how much outflow that I have to make to purchase that particular asset, and that is also called as the worth. This is, you have to remember, because these two definitions are merged now. Next, jurisdiction, right? We all know that what is the jurisdiction of the value or the valuation assignment that you're performing? The legal and regulatory environment in which the valuation is performed. What are the, like you are doing the valuation in India, what are the regulations or provisions for that? If you are doing the valuation in some other country, some other places, then what are the provisions under that, or what is the jurisdiction of that? 10.16, liability, the present obligation to transfer an economic benefit. This is already an question asked in the exam. The present obligation. If liability is being asked, it is not future obligation, it is not past obligation, it is the present obligation already been created. That is called the, as per definition, that is called the liability. To transfer an economic benefit, the liability has the following two characteristics. It is a present obligation. Please remember, this is asked as an MCQ already. The obligation requires an entity to transfer or otherwise provide economic benefits to others. Again, so obviously, if you are you are under a liability, then this benefit you have to provide to the next person. Next, 10.17, liquidation value, the most important. Changed scenario. Now, what is changed in liquidation value? Let's read from here. Under liquidation value, the gross amount that would be realized, gross amount that you will realize. What is, do you mean by liquidation? If the company is going to be sold, it is going to be liquidated, what value you will recover, right? So here, when an asset or group of assets are sold from a liquidation sale, now here the term is an asset or group of assets are sold. Even if assets are sold as a group, as a whole, still the liquidation value can be calculated for that group also. But in the, with the seller being compelled to sell as of a specific date. Oh no, look, liquidation value, you cannot say that I'm going to sell it maybe in the next 10 years, right? That is not liquidation. Liquidation value is some particular specific date you have to consider, right? But under the older standards, it was clearly mentioned that if you are calculating the liquidation value, you should consider a piecemeal basis. Piecemeal basis means you have to consider that all these assets are going to be sold separately, and then what the value they will recover. The problem was with this provision that there are some assets sometimes which as a collective asset can produce more cash flows even if sold in a liquidation situation, right? But if they are considered that they, you will sell separate assets, then they might not recover that much amount, right? So now that line has been removed from liquidation value definition, right? So there is no mandatory requirement as a value to you that you should consider the piecemeal, but yes, as a group, as a whole group, as a combination of group of assets, you can consider the liquidation value. The liquidation value takes into account the cost of getting the asset into saleable condition as well as those of disposal activity. Now, if the asset is here and for making it disposable or making it in a condition of sale, all those expenses should also be considered. That definition is also being removed. So then and there, as it is the as is where is basis, now you can calculate the value as per the liquidation value. So it is saying, and we will study the India's one, oh sorry, IVS 102 also, basis value appendix A60. It must be an orderly transaction with a typical marketing period. The only condition now is that you should consider a marketing period that should be lesser, because you are considering that you are going to liquidate this company, right? A forced transaction with a shortened marketing period, basically, right? So it should be a forced transaction, shorter marketing period, but there is no such situation that it should be on piecemeal basis, or it should consider the expenses that are incurred to make this asset in a saleable condition, or make it in a saleable condition. This, both the things has been written here, everything is written, but obviously the previous scenario was not written here. Last is market value, the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing. Now in liquidation, there was short-term period of marketing. Here proper marketing you can do. and where the parties had each acted knowledgeably, prudently, and without compulsion. In the liquidation, obviously, or a stress sale, the compulsion should be there. Here there is no need of any compulsion, right? So these were the paragraphs of glossary starting from 10.01 till 10.18. The balance we'll cover in the next video. So stay tuned. If you have not subscribed the channel, please do subscribe the channel so that you will not miss any important update. And in the end, I will also give you complete 1.5 hour videos in the fast forward mode, so that can be helped in revision. These handwritten notes will also be circulated with you, so that at the time of revision you can use directly those notes. In the time of study, we are going to use the red line edition, normal edition, as well as the handwritten notes, right? So this is it from my side for the day with respect to this video. Stay tuned, prepare well, and pass the exams. Have a great day. Thank you so much.